Good afternoon and welcome. My name's Kevin Igo, Director of PFP, and it's great to speak to you all today. This is one of our monthly webinars for our member firms and selected guests, and you're all very, very welcome. As usual, we will take questions throughout the webinar, and Jason and Tim, our guest speakers, have said that they like them, the more difficult the better, so please feel free to send them in.
Well, I think the answer was it depends.
Yes. At the end of the webinar, we will send out a copy of the slides to everybody in the normal manner. Now, for those of you listening for the first time, you are all on mute, and you'll need to send your questions in through the questions box that you should be on your screen somewhere. So today's webinar, Tax and Family Breakdown, quite a topical area in taxation. I'm pleased to introduce Jason Lane and Tim Gillett of Saffery Shampness, who are experts in this area. So perhaps, Jason, if I could start off with you, to introduce yourself and say a little bit about your background.
Yes, so I'm a partner at Saffery Shampness. I have been doing family and tax-related work to divorce for the last 20 odd years. Originally, it was doing Duxbury type exercises, and then the court changed to a sort of fairness and division of assets. That was following the case of White v. White, and often I'm to be found in the High Court giving oral evidence as a single joint expert. The courts have a tendency to prefer to have a single joint expert who not only deals with valuation but also tax aspects as well.
And Tim?
I'm a chartered accountant and chartered tax advisor, and work as a director in the tax team at Saffery's. And since joining the firm 4 years ago, I've been working with Jason in a number of these cases, tax cases in particular, and once had the pleasure, if that's the right word, of giving oral evidence at the High Court as well. So, yeah.
Excellent. So if we, without any further ado,
Okay, so the topics we're going to cover today are capital gains tax. This is particularly pertinent in relation to couples that are separating. In particular, the areas which often cause some consternation are the tax year of separation. Another aspect is the main residence, because that is often predominantly the main asset of value that's held between couples, and also in relation to shared disposals and how they might be treated, where you've got the opportunity to claim capital gains tax holdover relief. The other area we're going to cover is in relation to stamp duty land tax and second homes. A lot of the cases that I particularly deal with, the couple might well have a holiday home, or they might well have buy-to-let investments. And then the third area that we're going to cover is international issues. Particularly the work that I do in London, we have a lots of international type clients where one or either party are non-UK domiciled for tax purposes, and particularly the London sort of central family courts are quite popular with international couples, particularly wives, who, provided they can establish habitual residence here in the UK, this is not for tax but for legal purposes, can obviously look to lodge a divorce claim in the UK courts. So there are questions about how you might structure a divorce settlement where you've got a non-domiciled individual and you're looking at things like the remittance basis. So turning first to the tax year of separation, we have a basic rule in capital gains tax which is found in section 58 of the Chargeable Gains Act of 1992, which effectively says that if you've got a husband and wife or civil partners who are living together in a tax year, then any transfers of assets between them can take place on a no gain, no loss basis. In other words, no capital gains or no capital loss arises at the time of that particular transfer. And this is provided that the couple are living together in the tax year of assessment. Now, that treatment doesn't apply, the no gain, no loss treatment, if in fact you're looking at assets that form part of trading stock or would become part of trading stock of the transferee spouse. So That's the only caveat to the advice that I'm saying there. So let's look at what does living together mean. So living together is found, the definition for that is found in section 1011. This, of course, is tax simplification. So we've now got tax numbers in the thousands of ITA 2007. And the definitions there is a married couple or civil partners are treated as living together unless they are separated under a court order, separated under a formal deed of separation, executed under seal, or indeed witnessed in Scotland, because Scottish laws are different. And then finally, separated in circumstances which are likely to be permanent. And in relation to that third category, effectively what we're looking at is a position where the marriage or the civil partnership has broken down. And the test for that is one of where the couple are living apart with the intention to obtain a divorce at that time. And that can be the intention of one or both parties. So it doesn't need to be both parties. So in summary, living together means that you are living together unless you are separated by virtue of a court order, a deed of separation that might have been entered into by the parties and drafted by their lawyers, or indeed in relation to circumstances likely to be permanent. Now, issues arise if, for example, the couple remain in the same house. And in that case, if the couple remain in the same house, then they're not treated as being separated for tax purposes unless they have set up separate households within the home. And that might be quite important if it's the case that the couple are looking to transfer assets between one another on the no gain, no loss basis, and they wish to delay the formal date of separation until a later tax year to enable that to occur. And the authority for the position in relation to living in the same house and whether they're separate households derives from a case that in fact went back to 1949, and this is Hopes v. Hopes, where Lord Denning said that in relation to whether you were living in the same house as separate households, that the husband who shuts himself up in one or two rooms of his house and ceases to have anything to do with his wife is living separately and apart from her, effectively as if they were separated by the outer door of a flat. So if you have a situation where a couple are living under the same roof, but in effect are not living separately and are sort of sharing meals together, etc., then they won't be separated for tax purposes. And that might be quite helpful in relation to delaying the formal tax year of separation until a later tax year, where you've got assets that are standing at a substantial gain, which you might want to have transferred. Now, interestingly, the revenue did have some relief instructions manuals, but that's now been withdrawn. And in that particular manual, they raised some points for the inspectors to consider when deciding whether or not separate households have been set up. And the areas that they would look at were things like, how has the accommodation been divided between them? What are the arrangements for using the kitchen and bathroom and other facilities that they'll both need to use? What services do they provide for each other? Well, presumably they're looking at shared meals, or do they do their own laundry, cleaning, cooking and shopping? So those are some of the things that an inspector might look at in determining whether or not, if they're living in the same house, whether they've set up separate households or not. The next area is in relation to couples that might, for example, have a trial separation. And it's my understanding that if the trial separation lasts for less than a year, then effectively it would be ignored for tax purposes and the couple would not be treated as separated. If it goes beyond a year, however, then it might well be the case that they are treated as having separated. The other position is in relation to a couple that do formally separate but then reconcile, and the position there generally is that if they are reconciled after a separation, then they're treated as having effectively living together from the date when they move back into the same accommodation. If a couple is living together, they don't have a deed of separation or court order, they're living in the same house and not as separate households, then they will be treated as separated for tax purposes on the date of the decree absolute. And finally, there is the case that if they are living together perhaps, but they wish to then apply for decree nisi, and they are actually living apart. And there are 4 categories of applying for decree nisi. So I think there's 5, but the 2 which is relevant to us is in relation to the fact that you can make a claim that you've lived apart for 2 or 5 years. And in that case, you'll be treated as separated from the date which is 2 or 5 years before decree nisi.
So we have a question from Bill. Thanks, Bill. Client owns a property that his wife and children occupy. He's bought a separate residence that he lives in, but he hopes there will be a reconciliation. If he does move back into the family home, will he pay CGT on sale of the second property?
So this is the second property, well, that I think is going to depend in relation to the principal private residence relief rules.
Yeah. Okay. So another one from David, a client he visited yesterday whose father died in 65 without probate, mother died 2005 without probate, has 9 brothers and sisters, has paid for houses and weddings, etc. One sister now wants funds from a parent's estate. He advised them to do a family tree and see a solicitor. Is there anything else you should be advising?
I think undoubtedly there probably is, but that's quite a complex set of factual circumstances.
Right. So see a solicitor would be the advice then. Yeah. Okay. Okay. Thanks.
So, having determined the actual tax year of separation, the other consideration is actually when is an asset disposed of. And we have in the Capital Gains Tax Act under, this is at section 28, the normal rules in relation to disposals of assets, which is if you enter into an unconditional contract to sell an asset, then the date of disposal is the date the unconditional contract is entered into. If you have a conditional contract, then the date the asset is disposed of is the date when all the conditions are satisfied. If you have no contract, but for example, you have a physical transfer of an asset, then it will be the date of the physical transfer of that asset. But in relation to particularly divorce, the general rule is that assets will be treated as being disposed of on the date of a court order. And that would normally be a consent order. The only exception to that is where assets are transferred after decree absolute, where you have a court order that's been made before the decree absolute. Now, there may be some cases where, in fact, the couple don't agree a financial settlement until after decree absolute, in which case what then happens is there might well be a court order after decree absolute where assets are transferred, in which case it would be the date of that court order. So the general rule is that in a divorce situation, assets will be treated as transferred on the date of a court order. And I've had cases where the in HMRC have requested sight of the relevant court order in order to determine whether or not assets have been transferred pre or post the tax year of separation.
So if we turn to a very straightforward example with regard to the potential tax arising here, in the year of separation, as Jason has mentioned, we have the assets being transferred at a value giving rise to no gain or no loss. So in a simple example where the wife has owned a share portfolio, an investment portfolio for many years with a CGT base cost of 400,000 and a current market value of 400,000, the transfer in the year of separation will be at this no gain, no loss value, and the husband, as the acquiring spouse, then has a base cost for the shares of 400,000, and the wife has no immediate CGT liability. But of course, in this scenario, the husband, as the recipient of the asset, has the potential tax cost on the gain accrued to the transfer date, and that tax will obviously crystallise at some point in the future when there is a disposal. So we then lead on to the treatment in the tax year after separation. And as opposed to the no gain, no loss scenario, we then have a transfer which is deemed to be at market value. And the reasons for that I'll come on to shortly. And in that scenario, the husband would have the base cost for the shares of £600,000. And assuming that the disposal happens in the current tax year, 18-19, the wife as a donor has a capital gains tax liability of just over £37,500. Because the crystallisation of the gains accrued to date, she will pay tax on that and report through her self-assessment tax return in the usual way.
And I've had situations where, for example, a couple have taken advice early on in the tax year of separation. And in one case where the husband had listed shares, which were valued in their millions, and it was decided that it was quite likely that the wife on a divorce scenario would probably get around 40% of the overall marital pot. And so 30% of the listed shares were transferred before the end of the tax year of separation in order to benefit from no gain, no loss tax treatment. On the basis that it was likely that that would partially settle her financial claims on divorce, and it was tax efficient to do so.
And the timing of transfer will often be part of the negotiations on the asset split, as the tax cost will sort of be a factor in dividing the net assets that are available between the parties. So once we come on to the tax years post separation, until such time as the decree absolute has been granted, the husband and wife or civil partners are still connected for tax purposes. And the connected person rules are set out in the various sections of the Taxation of Capital Gains Act, as shown on the screen, and also further commentary in the revenue internal manuals. And with that, as we mentioned on the previous slide, that the transfer is deemed then to occur at market value. And the fact that husband and wife remain connected actually gives some opportunities for transfers of certain assets between them without triggering an immediate tax charge. And here we come on to the availability of holdover relief. And we're going to look very briefly at the assets that might qualify for holdover relief, the effect of a holdover relief claim, the time limit for making such a claim, and also the restrictions that would apply where any consideration is given for the transfer of the assets. So looking firstly at the gift of business assets and the assets qualifying for relief under section 165 TCGA. Here we have unlisted shares or securities in a trading company or holding company of a trading group, which in this case includes AIM listed shares. And we recently dealt with a case where a very significant part of the husband's assets were AIM listed shares and no cash available to pay any immediate tax liabilities. So again, the holdover election was very beneficial there. The next category would be listed shares or securities in a trading company or holding company of a trading group, where at least 5% of the voting rights are held by the transferor spouse. We then have assets that are used in the transferor's trade or profession, or by a trading company where, again, more than at least 5% of the voting rights are held. And the final category would be agricultural property, including the hope or development value there. So where we have a holdover relief claim, then what we're effectively doing is that the accrued gain to date and the tax that might be due on that is then deferred until a later date. So in addition to the 165 relief, we also need to consider the section 260 relief, where assets give rise to an immediate charge to inheritance tax. So where holdover relief is applicable, the effect is that the acquiring spouse would take on the historic base cost of the asset with the inherent gain to date, rather than acquiring at the market value. Now, there may be some circumstances where the holdover relief isn't necessarily the best course of action. And thinking perhaps in scenarios there where entrepreneurs relief might be available only to the transferring spouse, and it might be more beneficial overall to reduce the tax cost by crystallising the gain and not going for the holdover relief and paying the entrepreneurs relief rate of CGT on the disposal. Now, that's the effect of the holdover claim, and in order to make it effective, we need a joint election by both parties that is made within 4 years from the end of the tax year of transfer. And I think it's very important to note that the restriction of the relief that would apply where any consideration is given. And of course, consideration doesn't need to be in a monetary form. And HMRC is of the view that transfers on separation and divorce by one party to the other amount to the surrender by the transferee of rights, which they would otherwise be able to exercise in obtaining alternative financial provision. And so the value of those alternative those surrendered rights would actually represent actual consideration, and therefore the HMRC view would be that holdover relief wouldn't be available because full consideration has been given, reducing that gain to nil. But in the case of GVG, which is a 2002 case, Justice Coleridge made certain comments as to the tax consequences of court orders in divorce cases. And that led to a revision by HMRC of its practices such that transfers of business assets now can be free of any immediate CGT consequences, as holdover relief is available to be claimed provided that there is a court order in place. So the court has made an order for the assets to be transferred. And the reasoning for that is that HMRC now considers that the court order reflects the exercise of the independent statutory judgment of the court and is not a consequence of any party surrendering alternative rights in return for assets. So I think it's very important to note that if a holdover claim is contemplated, there must be a court order in place in order to make sure that that is valid. So just a quick summary of the key points to look out for in relation to separation. We have timing of transfers, year of separation, no gain, no loss for CGT purposes. Years post-separation, husband and wife, civil partners are connected still for tax purposes, and so we have market value transfers. Leading on to the potential for the availability of holdover relief. Also important to note that where assets are transferred to a connected party and there are losses, those losses can only be used on subsequent transfers on gains on assets transferred to the same connected party.
That's the point about clogged losses.
Yeah, clogged losses, absolutely. And then, of course, there are certain assets which are not necessarily liable for CGT.
So one of the things that a divorcing couple will do is that they will need to prepare what's called a Form E, which is a financial statement, and they will need to list all their assets on the Form E. And couples might well have a variety of assets, so we're just going to run through some assets which may or may not be exempt from capital gains tax. So you might have a husband or a wife who has some US dollars held in a bank account and on a money market account. Well, of course, they changed the rules in 2002 in relation to foreign currency bank accounts. So the US dollars are exempt from any tax on a transfer, but not in relation to foreign currency on a money market account. A vintage motor car. I'm not sure, Kevin, have you got a vintage motor car?
I haven't, no.
He hasn't, okay. Personalised number plate?
Yes.
Okay. So vintage motor car is exempt from any tax, but in relation to the personalised number plate attaching to the car, of course, that is regarded as an intangible asset of enduring benefit. And I once did a divorce case involving quite a well-known celebrity who had about 20 personalised number plates for his business. And of course, they are potentially chargeable to capital gains tax. Now, the issue with personalised number plates is actually valuing them, because they might have a value to one person but no value to anybody else. So the key issue is valuation. But technically, because they are an intangible asset, which is the order of the letters and the numbers on the personalised number plate, if you were to transfer or sell a motor car with a personalised number plate, then there may well be a gain arising on the personalised number plate. Government bonds and gilts, so you've got treasury stock and quoted company loan stock would be exempt from any capital gains tax. You might have the possibility of some accrued income arising on a transfer, which could be taxable. But in relation to any gains on government bonds and the quoted company loan stock, they would be exempt. So a racehorse and a tortoise. Now, so we have rules in relation to chattels. And so chattels are tangible movable assets. And then we also have a subcategory relating to wasting assets and non-wasting assets. So a racehorse, on the basis that it has a predictable life of less than 50 years, is free of any tax. And here we're assuming it's not used in a business, but it's just basically a sort of a syndicate or a hobby. But a tortoise, I've always questioned, because a tortoise can live to 150 years. So, and you do get some valuable ones. So on the basis that that has a predictable life of more than 50 years, and assuming that it's worth more than £6,000, then you could have a capital gains tax liability.
We've had a question there expected. What about a dog?
It's got a predictable life of less than 50 years,
Yes.
unless it's been genetically modified, of course.
So not yet.
Not yet. A yacht. Okay, so a yacht is machinery, and so there's legislation effectively that again it comes down to the chattels rules and wasting assets. So the machinery of a yacht will effectively have a predictable life of less than 50 years, so that's exempt. Antique clocks and watches. I had a client who did have a collection of very valuable antique clocks worth over £500,000 and watches, but because they contain mechanical parts, then in fact all of those are free from tax. So we know that people do collect expensive watches and clocks. So in terms of tax efficiency, they are very tax efficient.
Good.
Collection of fine wines and spirits. So here, the key question is, and it's in the revenue manuals, is whether or not they're likely to turn to vinegar or not in under 50 years. If you've got fine wines which are not unusually kept for more than 50 years, so they're not a wasting asset, then there could be capital gains tax to pay on selling the collection. Jewellery and furniture. So we have the chattels rules, and the chattels rules broadly say that if you dispose of jewellery and it's not worth more than £6,000, or indeed any furniture, and the individual items are less than £6,000, then they will be exempt from any taxation. However, if the piece of furniture comprises a set, then this £6,000 exemption applies to the set rather than the individual items in the set. So what may well happen, of course, in the heat of a meeting between husband and wife, the jewellery could be thrown across the table. So that's a disposal. So then the question is whether or not the engagement ring, etc., was worth more than £6,000 at the time it was thrown across the room. So all of these might appear on the Form E, and so one has to be very careful when advising a couple who are outside the tax year of separation as to whether or not there could be liabilities to tax, where, for example, the assets particularly if their chattels are worth more than £6,000. And two more, a Steinway grand piano worth £30,000, so that's worth more than the chattel exemption of £6,000. And there was a case, I think it was John Lennon's piano, that was sold for £1 million. And of course that was exempt from tax on the basis that it was likened to a typewriter inside, so the mechanical moving parts had a predictable life of less than 50 years, and therefore it was tax-free.
Oh, Jason has asked, what about pots and pans being thrown across the room?
I assume they're not the valuable ones.
No. Question from Martin. Thank you, Martin. Is a divorce petition sufficient where there's no court order contemplated with the availability of the Section 165 holdover relief?
You need a court order.
You need a court order. Another quick one from Emma. Client divorced in October. Settlement took form of a second home, buy-to-let mortgage, which has now become his primary residence, a holiday home and significant cash. He signed over his shares in their limited company in exchange for this. So questions are, is there a stamp duty repayment due on the residence and any CGT due on the shareholding?
Well, we're coming on to residence shortly, so we'll look at that first. Just in relation to the shares, they were business assets, were they?
Yes, in their own limited company.
Assuming it's a trading company.
So assuming it's a trading company with no accepted assets, there are certain rules if the balance sheet includes investments. But the point there would be to claim holdover relief, but you'll need a court order to do it.
Right, okay, thank you.
So often in the cases that we see, we've got the former marital home as being the main asset in the divorce case, and in every case the facts pertaining to things are going to be very key. And often we see disputes between the different parties where they can't even agree on the facts, and quite often the tax advice has to be heavily caveated depending on what facts are actually presented. But when we come on to the availability of the main residence relief, sections 222 and sequential in the TCGA, then where you've got a married couple or a civil partnership and they are living together, then only one PPR is allowed, and that will be determined on the facts, unless the couple jointly nominate where there might be more than one residence. If they are married but separated, then two PPRs may be in play, unless we've got this particular section in play, and that's where one of the spouses has moved out but still retains an interest in the former marital home and later transfers that interest to the other spouse, then providing the other relevant conditions are met, then there would still be just one PPR there.
So just in relation to the section 225B point, this was originally a concession that was legislated for. So in effect, so let's say the husband moves out of the family home and acquires another property, but still retains an interest in the original family home, and then after a period of time that property that interest is then transferred to the spouse that's continued to occupy the property, but it's outside of the 18 months that you get for PPR. So the husband transfers it, let's say, his interest to the occupying spouse after a 6-year period. So, but because he's been out there for 6 years, only gets the last 18 months, then the effect of this piece of legislation is to extend the exemption right up to the date of transfer. So in effect, there is no gain for him on the transfer of his interest in that property. However, the downside of making that particular claim is that he would lose the principal private residence exemption in relation to the house that he has bought. And often in these cases, if you've had a long marriage or family home owned for a number of years, because of the way the principal private residence relief works, being a sort of a proportionate part of the overall ownership period, then this particular piece of legislation is often not usefully claimed.
And of course, with cohabitees, they can each have a PPR, so this is unmarried cohabitees, and each should nominate their own property. Now, in the nomination of a principal private residence will happen quite often on marriage, where the parties have had a property each and then move into one but retain the second one. So it may be necessary to nominate which of them is the main residence if they're using both as residences. Nomination may be required on acquisition of a second or further property, again where used as a residence, where there's a disposal of a property and they still own more than one. And of course, the nomination must be made within 2 years of the event that triggers it. And in these days of internationally mobile couples, this can also include overseas homes. So we're not just looking at UK residences as well. And as mentioned in the previous slide, that cohabitees should nominate their own properties. And I think it's important to bear in mind that even if one of the properties is sold within the 2-year period, it's still possible to make that nomination as to which of them is the main residence. So once we've got the property nominated, then again it's exempt for the period of actual occupation of residence, plus, as Jason's mentioned, the last 18 months of non-occupation ownership. That 18 months obviously came into play about 3 or 4 years ago, where previously it had been 36, but of course it's now down to 18. Then other periods of non-occupation may also be included as deemed occupation, and that can include sort of a 3-year period of absence for any reason, a period of any period when the individual is working overseas full time, or up to 4-year periods where their work in the UK requires them to be absent from the property. But the important thing here is that those periods of non-occupation must be preceded and followed by a period of actual occupation for the PPR relief to apply. Then where the property has been a main residence and has been letted out, then we have lettings relief available where the property has been rented out, and this too has the effect of reducing any gain that may become chargeable on that. And again, as we've mentioned previously, that the PPR can be extended beyond the final 18 months of ownership, where the transfer is to a spouse who's continued to occupy the property and no other PPR has been opted by the spouse who's left the property. And I think the usual considerations where the property has a mixed use come into play. So again, in the type of cases that we deal with here in London, we're quite often seeing the big country estate with commercial land and buildings, as well as the residential aspect. And then we have what is the allowable curtilage, etc. The area of land that qualifies is an area greater than the permitted ½ hectare necessary for the enjoyment of the property, etc., etc. So all of those things come into play in determining what gain actually becomes chargeable. And of course, we've also had a number of recent cases where HMRC has challenged the PPR claim regarding the quality of the occupation. As with all of these cases, it's the quality of occupation that is relevant and not necessarily the quantity. And so we've just listed a few things there where the existing property is demolished and rebuilt, then you won't get the PPR there. Periods of repair and renovation can qualify, and short periods of occupation can be PPR depending on the intention. So just looking very, very briefly at a couple of cases, one dating back to February 13, the case of Susan Bradley was a separation case where, again, with the house being on the market, when she moved into it, HMRC felt that there was no intention to permanently occupy, and so the PPR relief was denied. We then had the Qatari case in 2016 where the individual was resident for 6 months, but it was deemed that the occupation lacked the necessary degree of permanence or continuity. Then those are contrasted with the case of Stephen Bailey, which was a 2017 case. A bit of a sad one, this, where the taxpayer had bought a house with the intention of moving in. For various reasons, he had to put a tenant in, and the tenant was a good friend of his. Tenant died, and so after the tenant's death and the widow moving out, Mr. Bailey moved in to redecorate and with a view to moving his family in. Because of the impact on his mental health that the death of his friend had and various other factors, he felt that he couldn't live there anymore, so he was there for a very short period. And despite the fact there was no real documentary evidence, the court accepted his oral evidence that there had been an intention. And so in that case, even though it was a very short period of occupation, the PPR claim was allowed. Now, the other interesting point in this particular case is that it was under a discovery assessment, and there were also further queries around the validity of the discovery assessment, and it was ultimately ruled that it was invalid. But I suppose the slight wonder is if that hadn't been the case, would it have been sort of pursued further, and would it have been challenged further? But so contrasting cases there as short periods of occupation and whether or not PPR relief is available.
But I'm conscious of the time here. But Asad's asked the question about how do they make the nomination? Right? Do they have to formally let HMRC know? Is there a specific form?
No, you just need to write a letter. And when I did it, it took them about 9 months to reply. So, but you do need to have that on file.
Okay. Husband and wife have separated, and under the court order, husband's required to transfer 4 out of 10 properties to his wife. Is it possible to appropriate wife's properties directly to a property limited company by way of court order to save stamp duty land tax?
So I think this is related to whether or not it comprises a business, and it can be put into a company. And I think you will need to take further advice on that. If they're jointly owned, there is something that we're going to come on to, which is exchange of joint interests in land. Now, in relation to divorce, actually, if there's a transfer from one party to another, there is an exemption from stamp duty land tax in relation to property transfers in contemplation or of an actual divorce. So my question here is actually stamp duty may not apply because there is an exemption that exists for property transfers on divorce.
Okay. Peter asks, what effect does a measure order have?
So a measure order, yes, a measure order is generally treated as a trust for tax purposes. They are not as common these days, and it depends on what the asset is going into the trust. Normally, it's the family home, and on the basis that principal private residence relief applies, the transfer of the property is to this trust. Effectively, the parents hold the property on trust normally until the child of the marriage has reached the age of 18 or in full-time education. And then at the end of that, the measure trust ends and the property comes out of the trust. But if provided is the principal private residence and the property is still occupied as the main residence, then there shouldn't be any tax implications from that. But clearly, one would need to understand the precise court order creating this particular trust.
Okay, thank you.
Just briefly looking at one of the things that might be looked at is in relation to of the family home, where, for example, one of the parties moves out, and because there are children of the marriage, the property is going to be held until such time as the child reaches the age of 18 or full-time education, in which case the property is then sold. So it might be the case that the wife lives in the property, the husband gives up his interest in the property, but in exchange for a fixed charge in relation to the sale proceeds when the property is eventually sold. So if you've got a fixed deferred charge, so in other words, let's say the property is worth, let's say, £500,000, and the husband relinquishes his interest in the family home for £100,000 charge over the property to be paid as and when the property is sold. That's a deferred payment. It's contingent on the basis that it's not going to be realised until the property is sold. But provided the amount of the payment is known, in this case it's fixed at 100,000, then the amount of that sort of charge is taxed today, but without regard to the fact that it's deferred or contingent. But as long as it's in relation to the family home, then it should be covered by principal private residence relief. If it was to be taxable and it later turned out that actually the husband in my example didn't get the money, then you can make a claim to have a repayment of any taxes paid. The other issue with deferred charges is it may not be a fixed charge. It could be a percentage of future sale proceeds. So this is regarded as unascertainable because you don't know the amount until eventually the property is sold. And you might well put a maximum limit on it, but you don't know what you're going to get. So in that case, that's regarded for tax purposes as what we call the shows in action. And you have to value the right to receive this future sum today, and that value might be taxed now. However, if you are in effect transferring your interest in the principal private residence in exchange for this future right, then the amount that you value today will be free of tax. But the issue is in future, when it's finally determined, then you might have a tax charge because what you're receiving is not in relation to the family home itself. What you have is a different asset, which is the shows in action. So you do need to be careful in relation to charges put on the family home and depending on how they're structured.
Okay, so I'll whip through the next bit onto the SDLT point that was mentioned in one of the questions earlier. And the warning for the second homes here is, of course, that we have the extra 3% on SDLT on second homes. And that includes those that purchased on marriage breakdown. So in the scenario here, it would be a case of where the former matrimonial home is owned in joint names, and before there is any sort of sale or transfer, a second residence is purchased, and in those circumstances the extra 3% SDLT will kick in. Of course, we've got the Welsh land transfer tax and the Scottish land and buildings transactions tax, so not thinking about those at all today. Now, so generally speaking, I think the view is that that these charges can be avoided with careful planning on the separation and on divorce, and where you've got court orders as well, that even if the 3% is payable in the first instance, then it's quite often will be repayable on sale of the former matrimonial home, or in other circumstances that may mean that there's a refund due. And we did have an announcement in the autumn budget last year that the government would be legislating to grant relief from the extra 3% in certain cases where, for example, there's been a court order issued on a divorce or dissolution of a civil partnership, and that court order prevents the disposal of the main residence. Other circumstances where a spouse is buying a property from their spouse, etc., etc. So all of those were announced last autumn. Now, in view of the time, included in the slides is a quick table as to the additional rates and how that applies, etc., etc., and an example as to how the effect of that extra 3% on an example purchase of 500,000. So that's all there. And then we've also got the Finance Act 2003 that also sets out various other exemptions that from stamp duty that apply in divorce scenarios, and that also includes one where perhaps the receiving spouse is also taking on responsibility for the mortgage, where in other circumstances that might trigger an SDLT charge. On divorce, it doesn't. So apologies for whipping through that very, very quickly.
And the SDLT exemption on divorce is found in Finance Act 2003, Schedule 3, Para 3.
And of course, in terms of capital gains tax on the second homes, the normal rules will apply, chargeable at 18% or 28%, etc., etc.
Now, one of the things that many practitioners are not familiar with or aware of is this provision about exchanging joint interest in land. So if, for example, a couple jointly own some properties, let's say as buy-to-let, but they wish to divide the properties up, and so that they will each take some properties wholly owned, then there's effectively a rollover relief provision similar to the rollover relief provisions you get for disposing of business assets and reinvesting in new business assets. It's found in section 248A, and effectively, if the value of the buildings or the land is the same value, then there's no capital gains tax. If the values are different, then there might be some capital gains tax on the excess value. So that's to say, if, for example, a husband gives up their half interest in a more valuable property in exchange for a property of less value, then effectively they can't roll over all of their gain into the property that they've acquired of the lesser value. But that rollover relief is quite important and should not be forgotten about. International issues, just briefly wanted to cover international issues. We have new rules for non-domiciled individuals effective from 6th of April 2017. Basically, if you've been here for more than 15 out of the last 20 tax years, then you cease to be non-domiciled for tax purposes and you pay tax on your worldwide income and gains. If you were originally born in the UK and have a UK domicile of origin and return to the UK, you cannot any longer claim non-domiciled status. We have a provision in relation to rebasing. So for individuals that were resident here for at least 15 out of the last 20 tax years on the 5th of April 2017, to the extent that they've got non-UK assets, then they get rebased to the value on the 5th of April 2017, and that is basically to their benefit, and it might well mean that they can have a clean capital going forward, because we're also able to look at their overseas bank accounts and investments and look to separate their what we call mixed fund accounts into clean capital, income and gains, but there's a limited period to do that, which is up to until 5 April 2019. So quite a few accountants are looking at the rules on that. They're not necessarily clear, because the guidance that's been issued by the Revenue is somewhat deficient on how you do that, but nevertheless we carry on. The remittance basis just generally acts as a deferral of a potential liability for foreign income and gains for a non-domiciled individual. So this is somebody that hasn't been here, resident in the UK for 15 out of the last 20 tax years. The deferral will become permanent if the funds are able to be spent overseas and never brought into the UK, or there's a certain category of remittances that they're allowed to do, but they are usually de minimis. And of course, what you're not allowed to do is to effectively make gifts to people that are closely connected to you and they bring the money in effect, because these are treated as relevant persons to you, and therefore you would be also caught if they remitted what would be deemed to be your income and gains. But in relation to separation and divorce, there is an opportunity to bring money into the UK. So what you have is the position that you can transfer a non-UK domiciled spouse's foreign income and gains to their UK resident spouse under a court order, because what happens is that after decree absolute, the UK resident spouse is no longer treated as a relevant person. And so what this means is that let's say husband in a case who's got foreign income and gains, that if the husband remitted the funds to the UK, they will be taxed on, can make an overseas transfer to their spouse, and provided the spouse brings the money into the UK after decree absolute, then it's not treated as a remittance by the husband. And so it's generally accepted that any payment under court order made to an overseas bank account for the transferee spouse where no remittance of the funds is made until after decree absolute is not a taxable remittance. So in actual fact, one of the upsides to international divorces between couples is actually you can do this bit of tax planning. What you can't do, however, is remit funds after decree absolute, which are then used directly or indirectly to benefit a minor child or minor grandchild, because they will remain relevant persons of the husband in my example who had that foreign income and gain. And I think finally, just wanted to mention there's an anti-conduit rule. So this applies where you have a distribution from an offshore trust. The offshore trust has untaxed income capital gains, and that is made either to a non-UK resident beneficiary or a non-UK domicile beneficiary who is not taxed on those monies because they are claiming the remittance basis, and that individual then makes an onward gift to a UK tax resident beneficiary in the UK. That has been largely curtailed, that form of tax planning, but HMRC has previously confirmed that if a distribution is used by a spouse to fund an obligation pursuant to a court order, the anti-conduit rule would not apply. So there may be an opportunity for there to be a trust distribution to a spouse who then uses those funds to meet his obligations or her obligations on divorce, and there wouldn't be an income tax or a capital gains tax charge.
And then finally, just by way of example on the points that Jason's mentioned there, if we assume that the husband is UK resident and non-domiciled and transfers funds, wants to transfer funds comprising untaxed overseas income and gains to finance a lump sum payment to his wife, there are a number of alternative scenarios. Some would be taxable and some wouldn't be. So a few quick examples. So if the transfer happened, was made by the husband to his own UK account prior to the payment to his wife after decree absolute, then that would be a taxable transfer. It would be a taxable remittance. Similarly, if he transferred the money to his wife's UK bank account before decree absolute, that would be taxable. But contrast that with a transfer by him to his wife's overseas bank account before decree absolute, and then the funds are brought to the UK by the wife after decree absolute. That would then be non-taxable.
On the basis that the wife is no longer a relevant person after decree absolute.
And then in contrast to there, thinking along similar lines about the relevant persons, where the transfer by the husband is to his wife's UK bank account after decree absolute, so they're no longer connected, but the funds are destined for the minor children, then those minor children are still relevant persons, so that would be taxable. And also a transfer by the husband to his wife's overseas bank account where the funds are remitted by the wife before decree absolute, again, would be taxable. So again, there are some planning opportunities here, and quite often what we're seeing is various indemnities put in place to cover scenarios where funds are perhaps used in a way that wasn't contemplated. But it's all a very complex area, very interesting, and lots of things going on in London in relation to divorce and international issues. And that.
Okay, thank you. Well, we've got a few questions we'll rattle through. One has asked to check: are we saying there's no stamp duty land tax up to 125,000 on the second home?
Yes.
She thought it started at 3% over 40k. Okay, let's come back on that one. Is capital gains tax payable on a DeLorean vehicle that's been converted to a Back to the Future car and is therefore a collectible item?
No, it's still exempt.
Still exempt.
I mean, notwithstanding the fact that you've got lots of cars that are highly collectible.
David asks, what if the money brought into the UK has already been taxed by the country where the money's been remitted from? that affect matters?
Potentially, there might be some foreign tax credit available against the UK liabilities that would arise, but again, it would depend on the scenario, the circumstances.
Okay. If a father transfers a property to a son and it becomes the son's PPR, is there a time limit before the property will qualify for PPR? So the father transfers a property to the son and it becomes the son's principal private residence. Is there a time limit before the property will qualify for PPR in the hands of the son?
If the son's living there,
if the son is occupying in residence, yeah.
If the family was settled into trust on divorce for the benefit of the child, the property is rented. When the child will attain the age of 18, will the trust incur CGT on transfer?
So in that case, the property is not being occupied by the benefit, it's being rented.
Yes.
So in other words, it won't qualify for the principal private residence relief. It'll just effectively be treated as a normal asset for CGT purposes.
If you have a non-resident husband transferring interests in UK properties to the wife, does the 30-day limit for reporting CGT relate to the date of financial order or date of transfer?
I think for reporting,
it's completion, isn't it?
Yes, I think it's the date of the physical transfer of the property rather than, so for capital gains tax purposes, it would normally be the date of the court order. But I think in this case, it would be the date when actually the conveyancing was carried out.
Okay. Somebody bought a property in February 78, got married in April 91. Property has always been registered in his name and has always been the family home. If you were to register the property out in joint names now, then would the PPR relief on one share for the period 78 to 2011 be lost?
Well, I think for capital gains tax, you don't go back earlier than 1982. So your starting point for the calculation is 1982.
Married in 91.
Married in 91.
Nothing like being put on the spot, is there?
Yes.
Okay, we might come back
we
on
might
that
come
one.
back to that. Yeah.
Okay, was there any movement on that 125?
Yes, apologies, there is a typo in the table. It is where the consideration is over 40,000 and the 3% does apply.
Right, okay, fine, thank you.
So apologies for the typo there.
Yeah. Okay, excellent. Well, thank you very much, gentlemen. On behalf of us all, I'd like to thank Jason and Tim for coming along today and giving a very, very informative webinar for us. There's a lot of content there and a lot of questions answered, so thank you both for that. If anybody has any queries on it, please feel free to email PFP in the usual way with any feedback you have. As I mentioned earlier, we will be sending out a copy of the slides to everybody. And I know I've said it, and I've had at least a dozen people asking me, will we really? Yes, we will. Now, we will be having another PFP webinar next month, so we're still very much alive and kicking. But I would lastly like to thank each and every one of you for listening today and hope to catch up with you again soon. If anybody does have any queries or questions on any of the PFP products or services, please feel free to contact us in the usual way. Meanwhile, have a good day and thank you for listening.